So good morning, everyone. Thanks for attending. So today what you're going to learn about is how to overcome the biggest obstacle of homeownership. So I'll talk a little bit about the audience right now that we're trying to sell to, right? It's mostly the millennials. Millennials, they graduate college, they all have degrees, they all have good credit. For the most part, they have the income, but they don't have the down payment. So what happens is they're living home with mommy and papi, right? Until they're saving money to try to get that down payment. And oftentimes, instead of buying, because they want to leave mom and dad's house, they'll end up renting. But to rent nowadays, you need so much money to rent. You know, you need first, last, and security. Sometimes you need two securities. So I'm going to show you in this training how you can take that money that they're going to save to rent and convert it into a sale. And what will that do for you? Well, it's going to triple or quadruple your commission if you compare it to a rent commission, right? Also, it's going to add some more referral sources for you. So if you capitalize on these programs, you should be able to add a dozen or more transactions in 2024. So let's get
Let's get that big head. Yeah. Hey, more money. Got that going, Mario? I know it's there. You go.
All right. So, you know, we're going to quote NAR, even though they might be going out of business soon.
Yeah.
Lawsuits.
I'm up for that.
They still are a purveyor of good data. And according to NAR, we have large percentages throughout the years of folks that first-time home buyers, which is one of the key audiences for these programs. Although one of the programs do not require to be a first-time home buyer, it is still the demographic that we all seek to try to take advantage of and get as many sales as possible. So the potential home buyers, if you look on the right, these are the amount of people that are just that already have a plan for how they're going to get the down payment. If you notice, they're very low percentages. And if you look on the left, these are the amount of people that don't have the down payment, that they don't know what they're going to do, how they're going to get the down payment. And this is who we are trying to go after. We're trying to go after more than 70% of the demographic that is wanting to buy a home, but can't because of the down payment. So this is your potential audience. So as I said, they plan on renting. So in order for you to rent today, especially in the South Florida market, you're going to need first class of security. And the average rent, I would say, is about $3,000 a month. So if you take, first class of security, that's $9,000. With these programs, I'm going to show you how, with less than that amount of money, you're going to be able to buy a home and take advantage of all the great things that come along with owning a home, like equity, pride of ownership, investing in your own home, upgrading, remodeling, and all those things. And there's also tax benefits, right? You said pets?
Yeah.
Yes, pets also. Unrestricted pets. Well, not if you buy a condo, though. You still have some restrictions. All right. So for those of us don't know who Ron Weber is, if you Google him, he called the place for the Washington Capitals, and he did almost 2,000 games in a row. So he's quoted a lot. And according to him, if it's too good to be true, it's probably fraud. And but I'm going to show you how this particular program is not fraud, because when I talk to agents and I tell them, hey, I'll show you how to buy a $500,000 house for less than $5,000, they don't think it's true. And there's a lot of myths out there, because lenders and brokers that can't do this program will thank you. I was going to say some profanity, but I'm not going to do that because we're recording. But they'll talk negatively about the program because they can't offer it. And they'll say something like, oh, they runs out of money all the time. Oh, no, you got to wait 60 days to close. Oh, you have to go to multiple agencies to get it approved. And none of that is true. If you're a big enough lender, like loanDepot is, you're able to fund these loans, underwrite. We have delegated underwriting authority. So we literally have closed these loans in 10 to 15 days. I mean, we have many examples. Probably as a team, we probably closed, I don't know, maybe 250 of these loans this year. So it is a strong, prolific program that every now and then does run out of money, but it gets replenished fairly quickly. So there's two programs we're going to discuss today. The first program is called Hometown Heroes. I'm sure you've all heard of it. It's one of the most common programs out there. And it made a big splash last year when it came out in June, July. It was supported by Ron DeSantis, and he funded it with $100 million. And I will tell you that the $100 million went in 2 months. It was highly promoted. So the anticipation, people were holding off. And when the program went live, everybody went nuts with it. And so consequently, we ran out of money. I don't know, August, September-ish. And then there was still a little bit of money available just for stuff that fell out of compliance. But eventually it went dry. And just about 2 weeks ago, they threw in another $36 million, and there's still about $15 million left over. So $15 million represents probably, I don't know, what's 15 million divided by 15,000, whatever that number is, about 1,000 loans. 1,000, that's pretty good, especially this slow time of year. There's plenty of opportunity, probably all the way to February. And then by then we're expecting another cash infusion into the program. The eventuality of this program is called self-funding. And so there's other programs that this organization provides. The organization is a state-run organization called Florida Housing. And the end game, if you will, for this program is for the program to eventually fund itself without the need of more cash infusion. And here's what I mean about that. So the $35,000 does have to be paid back. It is 0% interest and does not have a payment. So it's a 0% deferred interest for 30 years. However, if you sell your home or refinance your home, or it ceases to be your primary residence, you will have to pay it back. Now, remember, you're paying it back at 0% interest. So you're basically getting the money for free upfront to buy this property. So eventually we'll have so many loans that as people refinance or sell their homes, that money is being put back into the pool of funds available, and it's going to reach self-funding status where we will no longer have to be reliant on government to step in to infuse more money into it. So I would tell you that this program is not going anywhere. It's very popular. It started off, as the name suggests, with Hometown Heroes, paramedics, firefighters. As a matter of fact, if I remember correctly, there was 105 allowable professions. And because of the popularity of it, they made the change to make it available to everyone with some stipulations, some caveats that we're going to discuss. The other program is called FHA Access Zero. And this program solves for one important obstacle that Hometown Heroes has, and that's the first-time home buyer requirement. FHA Access Zero does not have a requirement to be a first-time home buyer. However, the program itself is not as pretty and is not as nice as Hometown Hero. It does have a place for a client, and it does reduce their cash to close significantly. It provides up to 5% of the sales price. So if you're buying a $500,000 house, you're going to get a $25,000 credit. So it's a beautiful program in that regard. The second ugly part about it, if you will, is that the second mortgage does have a payment. It is not interest deferred. You don't have any penalty to pay it off on either one of these, but the second mortgage does have a payment, and the interest rate is 2 percentage points higher than the first mortgage. So right now we all fainted because that's a big deal, right? However, keep in mind, it's a small loan amount. So it's not really terrible, right? And it saves your borrower about $20,000, $25,000 to close. So it's a good program in that regard. So let's dig in. So the first program is a nice program, right? Florida Housing Finance Corporation is a statewide program. You can do it in any county in Florida. Eligible buyers receive up to 5% of the first mortgage loan amount, up to $35,000, and you can use it for down payment and closing costs. It's not relegated to just down payment. You can use it. You just can't use it to pay off debt to qualify, and you can't use it for appraisal gap. Thank you, Barnaby. You cannot use it to cover the difference between the value of the house and the sale price, because that happens sometimes here in South Florida. I know that's shocking, right? Never. We all sell the homes for at value, right? The value that is worth. All right, here are the requirements. You have to have a 640 minimum credit score, and that's really not that hard to achieve. Honestly, sometimes we get customers that have a 630 or 629 or 635, and we kind of like play with their credit, and we run it through a simulator, and it tells us what's required for them to get to 640. We're pretty good at it, and we normally can get them there in 2 weeks, 3 weeks to get them to that requirement. You have to work full time. So full-time, this was a sticking point in the first iteration of the program, in the sense that full-time means different things to different employers. So what Florida Housing did is, to avoid the thousands of questions, is this full-time, is this full-time, is they set a standard. You have to work at least 35 hours to be considered full-time. So that is the minimum requirement to work 35 hours. So as long as your employer can verify that you work 35 hours. Now, if your pay stubs say 40 hours consistently, we don't even need a verification from the employer. But if they don't, we would need some type of verification that you're working at least 35 hours. The company must be based out of Florida, but it's a little more than just based out of Florida. Now, why did they put this requirement? Well, the reason they did this is because this is to build up Florida businesses, to build up Florida homeowners, to build up the Florida economy. So they're not going to want to give a loan to someone that lives in New York, for example, and works in New York. So they want this, or that lives in Florida but works in New York, because that business is in New York. So this is designed for to help, at the same time, to help out Florida companies. So the business that you work for, the employer that you work for, must be based in Florida. But not only does it have to be based in Florida, you have to be able to report to a branch that's close to the home you're buying. So as an example, if you work as a remote salesperson for a company in Panama City and you're buying in Dade County, there's no way that you can report to that employer. So more than likely, you will not be able to buy with this home, with this program. If you work for example, let's say you work for the corporate office of Uber. Well, that company is based in California and they have no branches here in Florida, so you wouldn't be able to do the loan for them. But if you're self-employed, cabinet maker, if you work for Walmart, if you work for any company that you have a branch to report to, a company location to report to, you qualify. You can work from home. That's not a problem, as long as there's a local office close enough to you that you can report to. So that's the requirement for the company, must be based out of Florida. You have to be a first-time home buyer. Now, I'm going to define what a first-time home buyer is, because depending on the program, depending on what you're doing, that has a different definition. So you can take the literal definition, first-time home buyer is someone that's never owned a home, but that's not what they're going after here. So what we consider a first-time home buyer is someone that has not owned a home in the last 3 years, or has lived in a home that they've owned in the last 3 years. Little tricky. So it's a technicality that's in our favor. So as an example, let's say that you lived in New York and you owned a home there, and then you moved to Florida, and you still kept that home in New York and you're renting it out. You are a first-time home buyer as long as you lived here in Florida and have not lived in that property in New York in the last 3 years. Same thing here. Yeah.
What if your property is in Florida, but you haven't lived there?
Yeah, So so the question is, what if the property is in Florida, but you haven't lived there? Same thing. It doesn't matter where the property is located. If you can prove that you've had it rented, and really the only way they truly approve that is through taxes, and you show the tax returns on your Schedule E that you've been renting that property for the last 30 years, then you're considered a first-time home buyer. So that is the requirement for a first-time home buyer. It's a pretty generous definition. And so don't think that just because your borrower owns a home that they can't buy the property. They can't be considered a first-time home buyer, and they could still take advantage of the program. So we're going to also ask, so if you put living with family, we're going to ask for a letter of explanation, probably from the person that you're living with, to confirm that you actually live there. The other thing that other requirement is, if you're renting somewhere, we'll probably ask for the leases for the last 30 years to show that you've actually rented there, and maybe a utility bill. So the other program requirements is 640. We talked a little bit about that. And by the way, all of these requirements are not really for you to memorize or to learn. As agents, we don't have that expectation. The expectation we have is to know, as they say, just enough to be dangerous, right? Enough to be able to offer it, enough to be able to get your borrower to a consultation, to all these cool loan officers that are here. And they know the programs in and out. I think everybody here has a bunch of them under their belt, so we know the programs pretty well. So don't worry yourself so much about remembering all the requirements. Just get to the point where you can say, to me, the most important thing is identify, are they really a first-time home buyer? And if they are, hey, there's a program that you may benefit. It's called Hometown Hero. So I think that in itself would be enough for us to set up a meeting and show them, and evaluate really if they qualify for the program. So, because we're going to talk about some technical stuff right now. Credit score 640. Pretty non-technical, pretty easy. If you are, evaluating a rental application for someone, you probably ran their credit, right? You guys run credit when you're renting for someone, I assume, yep. And so, yeah, so you'll have an idea of the credit score. The DTI, so DTI is debt to income ratio. For some of us that don't know what that is, it's just a fancy way of saying, can you afford to buy this house? And basically what it means is we'll take your new housing payment, your proposed housing payment for the subject property. We'll take all your student loan payments or your credit card payments or your furniture payments, any payments that you had that are on your credit. If the item is not on your credit, we're not going to count it. And then we're going to take that and we're going to add it up and we're going to divide that by your income. That is called your debt to income ratio. And so the maximum debt to income ratio on this program is 50%. There are some occasions where we can go to 50.49. And believe it or not, that little bit sometimes is the difference between a denial and an approval. But again, technicalities that we have to worry about that. We try to understand the little loopholes and anything that we can do to save a deal, we'll figure it out. So this loan closes in 30 days. Honestly, you can close it even less than that. We do not have a requirement to send this package to Florida Housing for them to evaluate. If you're a smaller agency, you do have to do that. So think about it, if you're a smaller agency, a smaller lender, you take the loan, you underwrite it, and you issue the approval, and then you have to send it to the servicer, which is Lakeview Servicing. They have to re-underwrite it, and they'll put their own conditions. It comes back to you, you ask for those conditions, and you submit it for final approval. You look at it as an underwriter in your organization, and you say it's final approved, and then you have to send it to Lakeview. And then they have to say if it's final approved, and if it's not, they'll come back with more conditions. So think about that back and forth. You'll definitely could be 30, 45, 60 days in that back and forth. Whereas if you do the loan with a lender that's large enough that has delegated underwriting authority like us, all that's out the window. We basically are responsible from A to Z, from soup to nuts, as they say, to make sure that the loan is sellable to Lakeview Servicing. And so with that in mind, we can close this loan. We've closed them in 10 days. The average is probably 20, 25 days because there's no rush. Usually contracts are 30 days, but we'll be happy to pick up, as they say, a Coast Guard rescue deal and be able to, you know, drive it home fairly quickly. So this loan comes in several formats. It comes in conventional, FHA, and VA loan types. And so sometimes, you know, realtors don't understand that this program is not a program that's self-standing with its own rules, although it has some overlays. This still uses the same rules as what we call the agencies. We call the agencies FHA, VA, Fannie Mae, and Freddie Mac. So this program uses those rules with just some overlays like minimum hours worked, the first-time home buyer requirement, and the maximum income limits. What was that?
Non-permanent residents.
Oh, yeah. So a technicality that Barnaby chimed in on is this program is eligible for non-permanent residents. However, the category of the employment authorization card is a point that has to be discussed right up front, because there are some categories that are not allowed and some that are allowed in FHA and not conventional, and vice versa. So if you're working with a non-permanent resident, maybe somebody on TPS, somebody on DACA or something like that, it is important that we know that up front to address whether this is a good fit for the program. So that's an important point. Thank you, Barnaby. This program does not have origination fees, and it also has reduced mortgage insurance if the AMI is under 80%. Another technicality that is not important for you to remember, but what is important for you to remember, although I will explain to you what I just said, what is important for you to remember is that this is just an additional benefit for your borrower, for your buyer, right? So what is AMI? AMI is area median income. And this is what the what HUD puts out of what the average middle income of that particular county is. So for Dade, Broward, and Palm Beach, it's the same. It's $67,600 or $5,633 per month. Now, that is not the income limit. That is the limit for you to get the additional benefit of reduced mortgage insurance. So it reduces your mortgage insurance by probably 40%. So if your mortgage insurance is $200, your mortgage insurance is going to be reduced by 40% of that. And why is that important? Because that's an additional benefit that you don't find in many programs. You're not going to find that in a standard Fannie Mae or Freddie Mac program. So this program does offer that. It's called Charter MI. So do you have to remember that? Nope. You just have to, understand that it's just another added benefit for your buyers, right? And so what are we doing? You're adding value to yourself, right? And when you add value to yourself and you have an incredibly satisfied customer and you have a family that's excited that they're buying a new home and they only had to come up with $4,000, $5,000, $6,000, guess what you're going to get out of that? Referral business, right? And so don't be shy to ask for the business. You go to your closing, you celebrate, and then what you do is you sit down with them and says, okay, now call all your friends, call all your colleagues, talk to the people at work, and tell them what happened, what you accomplished, and then give them my name and phone number. Never be afraid to ask for the business. So the other, and I didn't write that here, but I'm going to say it right now because it's a big, big advantage. So everybody knows that when you buy a property in Florida, you have to pay documentary deed stamps, which is 35 cents for every $100. And then you have to pay intangible tax, which is 2 cents, right? And so on $500,000, that's easily $2,200, $2,300, $2,400. And this program is exempt from documentary stamps. So no origination fee, reduced mortgage insurance, and no doc stamps. It's a winner. It's like it's a no-brainer for people to use this program. And the rates are competitive with standard programs, which we'll get into in a little bit. So the assistance does need to be paid back if refinancing, selling, or converting to investment home. So if you bought this property and 2 years from now, you decide you want to rent it, technically speaking, you will have to pay that assistance back. Is there a Florida Housing Hometown Hero police officer running around properties? No, there isn't. How they find out, I don't know. Could be that your homestead exemption gets canceled. Remember, this is a state program, and I'm sure they're tied in with the county. So that could be a way, right? I haven't really heard of a story. I don't know if any of you guys have of a story where somebody converted to a rental and they were asked to call back the
return to sender mail.
Okay, yeah. But have you heard of a case where it has happened?
Well, I had one where the person filed for homestead. When they sent them the trip notice, they said they got return to sender, doesn't live here.
Mm-hmm.
And then he got a call from the county, but he called me right away and he was like, "What did I say?" I was like,
You mean in a regular Florida?
No, on this program.
Oh, this program,
Yeah.
because it just happened to my son, but it's a regular program.
Oh, yeah. Okay, yeah. So there is some tie-in with the county with the homestead exemption. So I would tell you that, tell your buyers to keep that in mind, right? That this has to remain as your primary residence. But think about it, this program is really not designed for you to stay with it for 30 years. I mean, this is a program that you use to get into the property. And then the idea is you refinance, of course, with us because we have a lifetime guarantee, which we'll discuss in a minute. And to get out of this loan, get a lower rate, remove the mortgage insurance. So there's a lot of benefits to refinancing, especially if you refinance. If we originate the loan, then we refinance the loan, which I guess I could talk about it now because what better time than that we're on the topic. So Loan Depot has something called a Loan Depot Lifetime Guarantee, LDLG. And so what happens is when you close your loan, you get a certificate that says, this is your Loan Depot Lifetime Guarantee certificate. And what does that mean? That means that when you refinance your loan, we are going to waive lender fees. We're not going to waive all fees because you still have to pay county, doc stamps, title fees, and that kind of thing. But we won't charge you an underwriting and a processing fee, right? And in addition to that, you're going to get what they call a butler rebate from the title company. If you hold on to your owner's title policy and you don't throw it away or you don't forget where it is, you're going to get like a 50-60% reduction on your title insurance. I'm not a title agent, so don't attack me if I got that number wrong. But if you combine the reduction of the title insurance, no lender fees, and I've been told that if you go from if the note says Loan Depot and your new note says Loan Depot, the mortgage taxes are only the difference between the old loan and the new loan. So the title company that you use has to be on board with that, but there's an additional savings. So basically your Loan Depot Lifetime Guarantee will probably save you, if I had to guess, it's on a conservative number, $2,000 to $3,000 on your refinance. because everybody has to pay closing costs, whether you're refinancing or not. There's no such thing as a no closing costs refinance anymore. There used to be some banks had something like that if you were with them, but really honestly, it doesn't exist anymore. So just another benefit that we offer our customers, and of course, it's going to make you look good. And by the way, we are working right now our service statements, or the mortgage statements that the borrower receives currently has the loan officer's name, and we hopefully by the next quarter, the second quarter, it's also going to have the realtor's name that sold the property. So it's going to be present in every month in front of your buyer, because what happens if you don't keep in contact with your buyer, they'll eventually call somebody else and do the next purchase with someone else. So it's important for you to be top of mind with your buyers. What was that?
It gets added to the loan amount.
Yes.
Closing cost.
That's correct, yeah. So when you're refinancing, you don't really have to pay those closing costs up front. It gets wrapped into the new mortgage. But nevertheless, you'll be more than likely removing your mortgage insurance and paying off your second. So overall, you should see a pretty significant reduction in your payment, combining, with your lower interest rate. All right, so here are the income limits for the program. So typically, when you're doing down payment assistance, the income limits are a lot lower. They're usually 80% area median income adjusted for family. And what that means is that if you're just one person, your limit is going to be, call it 67,600. But if you have two kids, that's a family of three, you get more money. You're allowed to make more money. And if you're married, 4 kids, so it's adjusted for family. But this program has a definitive income limit, no matter how many people are in your family. And so for Dade County is 154,800. Now think about this, right? Down payment assistance programs that allow you to make 154,000. If you're making 154,800, do you really need down payment assistance, right? Well, this program, you could do it, right? Here's another beautiful thing about this program. This program is considered TBA, to be announced. And what that means is that the investor that they're eventually going to sell this to is going to be any investor that they find. So it's not the government. There's another iteration of this program that goes through the government. But this one in particular, so what does that mean? So let's say that your borrowers make $175,000. Well, that exceeds the income limit, right? But if $40,000 of that $175,000 is commission or overtime, you could just choose to not include that on the application. And now you're under the income limit and you qualify. So that's a beautiful thing about this program. The income limit for Broward County is slightly less, 144,000. Looks like folks in Miami make more than in Broward. And the income limits for Palm Beach is 146,100. So pretty generous income limits, if you ask me, for a down payment assistance program, because we do all sorts of down payment assistance. One of my loan officers, Brigida, gives $1 million to people on every transaction. Basically, people buy the property for $1. Damaris Martin is right behind her. They buy her property for $2 for her loans. So there's a lot of generous down payment assistance programs that have a lot of little technical, I would say, detractors that kind of get you out of qualification, but somehow they find a way of making it work. And that's for another training, right? So there's a lot of generous down payment assistance programs that if you're the right buyer and you're buying in the right place, you really can take advantage of it. All right, and the loan limits, really, the loan limits are, I put them here, but there are no real loan limits apart from the standard ones for conventional and FHA. So there's no defined loan limit for this program other than the actual agency loan limits. And what do I mean by that? Well, a conventional loan limit for you is, for everybody, is $750,000, regardless of where in Dade or Broward or Palm Beach you buy. It's $750,000 for most of the United States, with the exception of some high balance areas like areas in California, New York, and here in the Keys and Monroe County, you can probably go to a lot more. The FHA limit for this program is $557,750. That's a weird number, but we didn't come up with it. HUD did. It's not a limit of this program. It's a limit of FHA. And there is one cap VA. VA does not, because on a regular VA loan, I don't know if you knew this, but this law came out called the Blue Water Act. And in that law, it says that there is no real limit for a veteran on a sales price or a loan amount. So you could buy a $2 million house with a VA loan and do 100% financing. But if you're using this program, there is a limit. They follow along with the conventional loan limit. So I don't know if there are any questions, but if there are, someone has to say something to me. Honey, I don't know if you're manning that.
Yes, I am, but I haven't seen any questions.
problem.
Please raise your hand or put it in the chat if you have a question.
Interrupt me if you have to.
Yes.
Yes,
No preguntar en español.
dale.
En el caso que un comprador tenga el TPS
Ajá.
y puede usar el programa Hometown Heroes o no.
Ok, so la pregunta es si el cliente, el comprador, está bajo TPS de Colombia, Haití o alguno de esos países que tienen problemas. Sí, se puede, pero TPS es una aplicación para asilo, ¿verdad? Normalmente, temporary protection, but it's usually political asylum of some sort, right? Depende en la etapa que están en el proceso. So, si tienen el political asylum, el asilo ya aprobado, sí puede. Pero si no está aprobado, se puede hacer el préstamo en este programa convencional, nada más. Is that right, Barnaby?
Yeah.
Okay, yeah. No se puede hacer FHA, se puede hacer convencional.
Y los intereses
Iguales,
iguales.
iguales. O sea, el programa enteramente es igual, no importa si eres TPS, DACA, si eres ciudadano americano, permanent, no importa.
¿Y hay team number? ¿Con eso se puede?
No, con ITIN no se puede.
Eso es algo que si tiene un cliente así, la mejor cosa que hacer es verificar la carta que tiene una categoría. Y ellos ya tienen un formulario donde se puede checar desde un principio si va a ser un problema o no ser un problema. Normalmente lo que se ve es C08, que es el TPS. A veces sí es C09, C09 normalmente viene con una visa acompañada. Si no tienen esa visa no se puede hacer. Entonces, muy importante preguntar eso desde un principio. Y los problemas que yo he visto con otros lenders que no han hecho Hometown Hero o otros programas de Florida es eso, que no verifican eso y a lo último cuando se dan cuenta ya.
TPS es súper común en South Florida.
Yeah.
So, una de las primeras preguntas que yo cuando hablo con un cliente y ellos también es ¿a dónde van a comprar? ¿En qué condado? ¿Vale? Y cuál es si son ciudadanos americanos, si son residentes
¿Cuál es su estatus?
¿Mm?
¿Cuál es el estatus?
¿Cuál es el estatus? Eso es importante porque esa pregunta tiene que ser una de las primeras preguntas que uno hace.
Thank you.
You didn't put here that there's the purchase limits, acquisition limits.
There are none.
Yes,
There's no sales price limits on this program.
yes. And the hometown notice,
Pardon me? Only loan limits.
go back to.
Hold on, they're checking to see,
Purchase price limits.
they're fact checking.
Purchase price limits. Come see, come see.
Purchase price limits, isn't that the 750 and 557?
Those are the loan limits.
If you click on it, says purchase price per read, it says loan limits.
No, they should remember.
Okay, so there are no purchase price limits. There are only loan limits. There isn't.
Oh, so that's two different things. Okay.
Yeah, because the reason they're saying that is because there are programs from Florida Housing that do have a purchase price limit. This one doesn't.
Oh, no purchase price limit.
Yeah, Florida bond is purchase price.
Yeah.
Yeah.
Non hometown hero.
Yeah. Okay, so this is really okay. So what you're looking at is a example of 3 different sales prices. So this is something realtors can really sink their teeth into. And by the way, we provide this little easy to read table to all your pre-approved buyers. We have a program that allows us to quickly give a borrower an estimate, which is pretty accurate within a few $100s. This incorporates all title fees, it incorporates all closing costs, insurance, taxes, everything you can think of is incorporated in this program. So option 1, right? Option 1 is a $450,000 purchase. Option 2 is a $475,000 and option 3 is $500,000. And so if you go down each line, it tells you, like in this example, it's a 3% down payment, 97% financing, 97 minus 100 is 3%, right? And then where you have your loan amount, which is 97% of the 450 or the 475 or the 500. And then you have the MI factor. This is the mortgage insurance factor, and this will fluctuate based on credit. If you have a really strong credit, that might go as low as 0.2 or 0.3. If you have a really bad credit or like struggling to 640, 650, you're probably gonna look at double that, right? So when it comes to that, we might consider putting you in an FHA loan. Because the FHA is much more generous, or not generous, but
PMI factors low.
yeah, forgiving. That's the word I'm looking for. It's much more forgiving on credit. Right? So on a $450,000 property, we're estimating taxes of $4,500 just for scenario and example purposes. Insurance $3,000. We all know that insurance is through the roof nowadays here in South Florida. It's a big problem that's really affecting affordability for us. I mean, we have to worry about the interest rate. We have to worry about the sales price. And now we have to worry about insurance. But I'm not negative though, because we could still find a way.
There's always a way.
There's always a way, right?
But we don't have it.
All right, then you have your term, 30 years, which is 360 months, right? And then you have your rate. So this is probably what the rate is today, 7.125. Yeah, I think last week it was 6.75, believe it or not, we have a little dip. These fluctuate just like any normal rate program and rate structure, right? So there's your P&I, your taxes, insurance, and your mortgage insurance.
Mario, can you hear me? Mario, can you hear me?
The requirements are, what do you mean by that?
Yeah, that we were talking about the 3 years and a person.
Yes, so the question on the table is there a different requirement as far as first-time home buyer, credit score and all that stuff? If you went conventional rather than FHA, rather than VA, and the answer is yes, the requirement is identical. The only difference is that VA does have a cap of 750,000. It matches conventional because with VA you can't a regular VA loan can actually go to any number. That's the only overlay on VA. So the only overlays on this is what we talked about. Minimum hours work 35, has to work in the state of Florida and a branch near you. It has to be a first-time home buyer as we defined it. So if you take a look, if you keep going down the list, you have your prepaids, which is 1 year of insurance, 3 months of taxes, and 3 months of insurance. Again, technicalities that you guys don't need to know, just suffice to know that this is as accurate as we could possibly get it. Then you have your closing costs, and inside your closing costs is everything that is involved, which is your any title fees, any appraisal fee, any other lien searches and things like that. So all that is built into this. Your underwriting and your processing fee are built into this, so there's no additional costs. So then you have your prepaids, your closing costs, and then your down payment. Those are all charges to the borrower. And then you get the credit of Hometown Hero. So as you can see, I oftentimes have a realtor say, hey, how do we apply the down payment assistance to the down payment? It really doesn't work like that. If you ever look at a closing disclosure, it's just credits and debits. And really, that's all it is. So the Hometown Hero is going to be a credit of $21,000. If you add up the down payment, the closing costs, and the prepays, and you subtract it by the Hometown Hero assistance, you're left with what you see there, $5,213.24 to buy a $450,000 house. So as you go up in sales price, the amount of money that you need to bring to closing decreases.
What?
Yeah, that's right. She said what? And oftentimes I get that question, so I'll say it again. So the higher the sales price, the less amount of money you need to buy the property. So if you buy a $200,000 condo, you probably have to bring $6,000 or $7,000. If you buy a $600,000 condo or a house, you probably have to bring $3,000 or $4,000. Can one of you loan officers tell me why?
Because the loan amount is based on 5%.
Right. It's just math. It's 5% of the loan amount. The higher the loan amount, the bigger the credit. The other costs involved, like your closing costs and your tax and insurance, don't proportionally go up with your sales price the way the assistance does, right? You're not gonna pay thousands of dollars more in closing costs because you bought a $500,000 house over a $300,000 house. You're gonna pay, you know, maybe a couple of $100 more, but the assistance radically changes, just mathematically. So as you can see, you can buy a $500,000 property for $4,500.
Which is a lot less than your 3 months that you need for rent.
A lot less than the 3 months that you need for rent, you know, first, last, and security.
Absolutely.
And here's the other thing, realtors, how much is rent on a $500,000 house? A house that's worth $500,000, what do you think you'll be paying in rent?
$4,500.
$4,500, especially in Miami. It's outrageous. Look, you're paying $41.99 and you own the home. And you're buying it for less than what you're renting. Honestly, agents, this is a no-brainer. You should be bringing your buyers in droves to us. You should be making a ton of money in commission because you have a competitive advantage. You clearly understand the program. You're going to keep these slides that I'm going to send to you guys, and you're going to be able to speak intelligently about the program. You're going to be able to offer it with confidence because you have a strong support system behind you, us, right? You put us in front of any buyer, we are able to articulate and quickly identify if your borrower qualifies for the program. And that's a strong partner to have on your side. So think about all the people that decided that they didn't want to buy, they wanted to rent because they want to stand on the sidelines. I would be calling my database of all my buyers and just tell them, hey, listen, I just heard about this program. I would go on social media and post, ask me how you could buy a $500,000 property for less than $5,000. You're going to get people that are interested. Make a social media video. We have plenty of loan officers that would love to do a video with you. You know, just you and them talking about the program, strategically structured in a way that catches everybody's attention. We do that regularly. We have experts on the team that love social media. Carrie Romero loves social media. She even does yoga on the beach on social media. She invites agents.
Yeah.
So take advantage of that.
El interest rate cuando se usa el Hometown Heroes es más bajo.
So la pregunta es si la tasa de interés es más baja si usas el programa sobre un programa normal, ¿verdad? So the question on the table is the interest rate lower when you use the Hometown Hero program as compared to a regular conventional FHA or VA loan? And the answer to that question is ready?
Yes.
Maybe. Depends on the credit score.
Because I
Yeah.
see these.
Well, these three are the same because this is just the only thing that changes here is the sales price.
Es comparable.
Yeah, apples and
Es
apples.
bien comparable.
Es comparable y cuando haces la comparación entre los beneficios de no usarlo, siempre ganas el programa.
Yeah.
Especially the score is really
Porque
low.
mira, now, el-
So para darte un ejemplo, vamos a suponer que tu cliente tiene un 800 credit score, right? Eso es un cliente que cuida su crédito y vamos a suponer que tienen su propio down payment, aunque no es necesario. Ese cliente va a ir al banco y va a esperar una tasa de 1%, porque,
Yeah.
¿verdad?
Sí, porque tiene un buen crédito.
Right. So you got a customer with an 800 credit score, that has their own money. They're going to go to the bank and they're going to expect an interest rate of 1% because they're walking on water, financially speaking.
Yeah.
They won't like this interest rate. They'll want a 6% or a 5.99. That's not the borrow for this unless they are strapped for the down payment. They don't have the down payment. And then what you do is, as a good salesperson, you sell them the benefits of this program. Mr. Smith, I know you have great credit and you're looking for a lower interest rate, but this program will allow you to get into the property with very little money down payment, and you can then refinance at a much lower rate with a regular program a year or two down the road. So este programa no está hecho para todo el mundo. Los clientes que tienen el super crédito y están esperando una tasa super buena, este no es el cliente para eso, pero si el cliente le hace falta la cuota inicial, este programa es ideal para ellos. How's my Spanish, Ivan?
Excellent.
I've been honing it. So la respuesta a la pregunta es si el cliente tiene un puntaje de crédito super bueno, puede ser que esta tasa sea mejor en un programa convencional, no FHA, pero un programa convencional definitivamente. Pero Vamos a suponer, ¿qué es la diferencia entre un programa convencional con buen crédito y este programa? Vamos a suponer que la tasa de interés para un programa convencional con buen crédito es 6.8, 6.9. No es gran cosa. La verdad que no es gran cosa. Ok. So, vamos a seguir al próximo ejemplo. Bueno, vamos a hablar un poquito más de este servicio que nosotros damos. Ese proveedor ofrecemos. Vamos a add that. Bueno, cualquier de los loan officers que nosotros tenemos tienen acceso a este programa. Si usted llama si un cliente, a veces los clientes no quieren que le corran el crédito. El cliente quiere saber, bueno, nada más quiero saber el pago porque no quiero correr mi crédito porque tengo miedo que me va a bajar los puntos. Eso es un tema que ahorita vamos a hablar, que es una cosa que la gente no entiende, pero how do you say myth in Spanish? Es un mito. There you go. Vamos a how do you say debunk? Vamos a explotar ese mito.
Vamos a explotar.
Vamos a explotar ese mito. Ok. Pasaron una ley. Esa ley se llama el Deduplication Law. Salió hace, no sé, 8 o 10 años. Y la ley dice esto. Si usted está buscando la mejor tasa, en otras palabras, usted está you're shopping, estás buscando el mejor escenario para usted. Usted puede correr su crédito entre un rango de 30 días con tal que la compañía que está corriendo el crédito está registrado como un mortgage company. Usted puede correrlo 100 veces y va a contar como un hard inquiry. So, cuando la gente me dice, no, corrí mi crédito con fulano de tal, ABC Mortgage, y no quiero correr otra vez. Bueno, señor, eso cuenta como uno, con tal que fue menos de 30 días. Y para comprar un carro es 20 días. Y para aplicar por una tarjeta es 10 días. So, no se preocupen tanto de eso. Miren, en este país, una de las cosas más importantes para los negocios es poder competir. Competir, right? So, nosotros no tenemos ningún problema con competir con otro lender. Ahora, le voy a decir una cosa. And I'll say it in English when I'm done. Esta tasa no es para discusión, no es para, ok, tú tienes buen crédito, voy a dar una tasa mejor. Yo le doy el enlace al programa y ustedes van a ver la tasa. No es un secreto. La tasa es igual para una persona con 800 y una persona con 640. Igual.
Eso es lo que hay en el día.
Yeah, o sea, esto no tienen ningún ajuste a la tasa. So, what I'll talk about when people tell me that, the interest rate is too high, what I simply do is I give them the link to the website. And I tell them, here is the interest rate. It's a public website. It's accessible to anyone. It's no secret. Lenders are not allowed to pad this interest rate. The interest rate is the same for someone with an 800 credit score and someone with a 640 credit score. There's no difference. That's the beautiful thing about this program. And so when I talked about competition, I think it's important that, in the United States, one of the cornerstones of our economy is competition. It's important that we're able to compete. This gives the consumer the best deal that they can possibly get. If you're a customer and you're shopping for a mortgage, sure, go to multiple lenders and see what you can get and see what's the best offering you can get. But don't forget there are intangibles other than the interest rate, right? Is that loan officer available to you? And when you need them to be available to you, I can guarantee you your Bank of America loan officer will not answer their phone after 6 p.m. I can guarantee you that your Wells Fargo loan officer will not be available for you on Saturday and Sunday. I can guarantee you that your Chase loan officer sees a wrinkle in your finances and will be able to do it. I can guarantee you that your Truist loan officer will not be able to close you in 30 days. I can guarantee you that your Citizens Bank, your TD Bank, your Region Bank loan officers, your Citibank loan officer probably do not offer this program. Sandy, come up here and do the chicken dance for having your phone off. So keep that in mind. I'm not saying that we're the only game in town. I'm just telling you that we have a lot of offerings and I encourage you to, shop it if you have to, but you'll find that you're going to get excellent customer service.
We work hard to pay for you.
You find that we work after hours and we pride ourselves in white glove service. And whoever does it, you just let me know and I will pull their ears. All right. So let's continue on to the next slide. So your borrower is not a first-time home buyer, but they still don't have enough money to buy the property. So now we fall back on this program.
Oh, I was gonna ask you.
There are several reasons why we would use this program. First of all, the name of this program is called FHA Access Zero. Okay? This program is our fallback program when you don't meet one of the requirements from Hometown Hero, or if at that moment Hometown Hero temporarily does not have money. So this is what the program we use. This program does not require you to be the first home buyer. This program minimum credit score is 600 as compared to Hometown Hero 640. This program does not have an income limit. This program does not have a sales price limit, but neither does Hometown Hero. However, it does have to be FHA. So although this program has some nice things to it, it does have some things that some people would consider not so nice as compared to Hometown Hero. Right? So let's dig in. So because there are not that many requirements, I really don't even have to talk about, I don't have to talk about income limits. I don't have to talk about price limits. I don't have to really talk about full-time employment. None of that's required. So basically you need a 600 credit score. If you have a 620, 620. All right. So if you have a 600 credit score, again, you don't have to memorize this. This is for us. If you have a 600 credit score, this program gives you up to 5% of the sales price. But if you don't have a 620 credit score, if you're between 600 and 619, you can only get 3.5%. Am I right, guys?
3%.
3.5. Yeah, that's what I thought. It's 3.5. Yeah, 3.5. There you go. You learned something today, Jose. So you can only borrow to 3.5%. And there's also a cap on the debt to income ratio that we discussed, and it is 45%. Otherwise, if you're 620 or higher, it is 50%. Now, just to put it into perspective, right? That is one thing that's important is that if you went with a regular FHA mortgage, the maximum debt to income ratio is 57%. Much more generous than this program, right? But Hometown Hero is 50 also, and this one's 50, right? So that's pretty much in line with most down payment assistance program, would you guys say? Yeah. So 50% is the maximum debt to income ratio as long as you have a 620 or higher. How hard is it to have a 620 credit score? Honestly, it really isn't. And I would tell you that if I took a look, I mean, last year, my average credit score for the whole branch, for the whole area actually, was probably 660 to 680. Wow. So most people have this score. All right. If you have less than a 600, we will try to work to get you higher. But more than likely, you know, if you can't, you can still fall under a regular standard FHA program. So same example, same sales prices, 450, 475, and 500, right? Look at the mortgage insurance is 0.55. So that's going to be the same for everybody because FHA does not distinguish on credit score whether they give you a higher or a lower mortgage insurance rate. Everybody gets the same rate. Okay. You got your loan amount, which is not 96.5% of the sales price. It's 96.5% of the sales price plus something called upfront mortgage insurance premium. Do you technically need to know what that is? No. But every FHA loan has a 1.75% premium that is paid to HUD for when you purchase using an FHA loan that gets added to your loan amount. And that is why the loan amount is not that you're looking at right now is not exactly 96.5%. It's 96.5 plus 1.75%. Sometimes smart borrowers will calculate that and they'll think that we're ripping them off. And then we'll 1.75%. And then we'll send them a nice, cute little video on what mortgage insurance premium is. And then they're like, oh, thanks, Mario. So yeah. So that's why the loan amount's not exactly 96.5%. We use the same example for taxes, the same example for insurance. And then the interest rate may be slightly higher on this. Then you got your payment, your taxes, insurance, blah, blah, blah. And then you have your standard closing costs. And here is one of the very key differences that you're not going to like is that this program does have discount points. So discount points. Yeah, whereas the other one did not. So in this example, this looks like it has just a little over 1 point because if you take 4670 and you divide it by 441849, which is your loan amount, you'll see that that's a little bit over 1 point. That was, I don't know, maybe yesterday's rate. Could you take a higher rate and not pay points? Yeah, you could. You could. But in this example, so you have that large amount of discount points. You have your down payment, and then you get your credit, which is 5% of the sales price. The credit is 22,500. Now, in this example for Hometown Hero, you were bringing in 4,500, 4,900 to closing, and this one is $13,000. So while you may say, "Oh my God, Mike, that's a lot of money," if you went on a regular FHA loan, that number would be $30,000. So keep that in mind. You know, this is still a very generous program, and $13,000 is not a far cry from First Class and Security.
And it can be a gift.
And it could be a gift, 100% of it. Thank you, Carrie. So I'll point out something that I kind of skipped over because it's important. If we go back to the payment details, right? Your interest rate is 7.25. Your principal and interest on your first mortgage payment is $3,014, and then your second mortgage payment is $288. That is a key difference between this and Hometown Hero. The payment on Hometown Hero is 0, and it does not accrue interest. This one does accrue interest. It's based on 15-year. Does anybody know?
Amortization wise?
Yeah, I don't remember.
10 years.
It's 10-year. It's a 10-year amortization, and it's 2 points above the first mortgage interest rate. So in this example, the interest rate is 9.25 on the second mortgage. Don't fall out of your seat. Don't fall out of your chair. Don't spill your coffee. 9.25 is a high rate, but it's on a small loan amount of $22,500. No prepayment penalty. You can pay this off whenever you want. And this is an ideal program for someone that's not a first-time home buyer, somebody that doesn't work the 35 hours.
And their credit is not.
And their credit maybe is not the 640 or good enough for Hometown Hero. So there is a place for this program. Your job is to find that place, right? So I'm going to stop here to see if there's any questions, because I did talk a lot. I don't believe that I've been on for an hour and 48 minutes, but
You're gonna talk about the requirements?
I did. There are no requirements other than the credit score.
So
It's a regular.
And what was the other one you said?
Not a regular FHA.
No,
Credit score and DTI.
credit score and debt to income ratio are the only real requirements on this.
it doesn't matter if I own a property.
Correct.
You do not have to be a first-time home buyer.
That's the beauty of it.
It's a much more lenient program. And here's the other thing. Well, we didn't talk about this, but I'll just mention it. When you're dealing with a conventional loan, the ability for you to get an automated approval through what you guys know as DU, and there's another one called LP. Those are the automated engines, the decision engines from the agencies, Fannie Mae and Freddie Mac. It's much more difficult to get an approval with somebody with a 640, 650, 660 on conventional loans than on FHA loans. So on this loan, it's very lenient on credit. You could have collections, you can have charge-offs, and you more than likely will still get an approval compared to a regular conventional loan, whether you're going Hometown Hero or not. This program only comes in the FHA flavor. That's it. It does not come in conventional. It does not come in VA. It only comes in FHA.
I have a question from one of my agents.
Okay.
He's saying that if you could buy points, this Hero FHA, and I said, yeah.
That is a great question. So the question on the table is, can you buy points on this program? And the answer is yes.
What about the second compared to?
Well, the second will go down as you bring down the first. So yes, so the answer is yes.
Mhm.
And here's another thing about this program. If I'm not mistaken, they've already added the buy down feature on these.
Yes.
Okay, so we can add what we call a buy down. And without going too much down the rabbit hole and on a tangent, a buy down is when you don't permanently buy down the rate, you temporarily buy down the rate. And the way it works is, let's say you do a 2-year buy down. What that means is that the first year, your interest rate is going to be 2 points lower than your real interest. Your real interest rate is 7.25. But if you purchase the buy down, on year 1, your interest rate is going to be 5.25. And on year 2, your interest rate goes to 6.25. And then on year 3, it goes to the normal rate of 7.25. And why is that important? Because sometimes the borrower wants the house. We know the rates are going to go down in a couple of years. They get the benefit of getting the lower rate for the first 2 years. And, you get raises, you get increases in income, you change jobs, you make more money. So the second year when it goes up, hypothetically speaking, you're making a little bit more money. You can afford to change in payment. And so that is the theory behind the buy down. Now, sounds like a no-brainer, right? But there's a catch. And the buy down feature is available to any program. Well, any normal program like conventional without any down payment assistance or FHA or even VA. But Hometown Hero does not offer the buy downs. This program does offer the buy down. And there is a subsidy fee, a buy down subsidy. And how do you calculate it? So whatever your payment, your real payment is at 7.25 minus your payment on year one at the lower rate, that difference, call it $200 or $300, call it, times 12 is $3,600. That is part of the subsidy fee. Then you do the same math on the second year. What is your payment at 7.25, your real rate, and what is your payment at 6.25? Because the way the 2-year buy down works, the first year is two points less, the second year is 1 point less, the third year goes to normal. So the difference in the second year between the real payment and the payment that's 1% less, that gets added to the buy down subsidy. You add those together, and that's what it costs to get the buy down. Who can pay it? The seller can pay it, or any other interested party. I don't want to say the agent can pay because I might get tomatoes thrown at me. The agent can pay it, and the lender can also participate in paying that, helping with that buy down subsidy. But I'll tell you, as a strategy, if you're a listing agent, instead of, so let's say you have a property for sale for $600,000 and you're not getting the activity that you want, and you sit down with your seller and you guys say, I'm going to lower the rate, the price of $580. I will tell you, don't. Why don't you offer a subsidy, a buy down subsidy? So instead of lowering the sales price by $20,000, offer a $10,000 buy down subsidy. So you put on the MLS, hey, buy this property for 2 points under market rates. Ask me how. Seller motivated, we'll pay buy down subsidy or something like that. And I can guarantee you're going to get more activity than just reducing the sales price. Because, you know, when you have that conversation, you may get an agent that said, hey, what do you mean by this? Oh, your rate, let's say your rate is 7.25, your rate would be 5.25 the first year and 6.25 the second year. Talk to Bridget, talk to Damaris, talk to Patrick, talk to Sandy, you know, our loan officers. And they'll explain the program, and the seller is willing to pay for it. So the seller is saving $10,000 instead of lowering the sales price by $20,000, just offer $10,000 or $12,000 in a buy down subsidy. That's a nice strategy to make more commission. You got to get paid on sales price, right? So that's a nice little nugget of information, which, by the way, we are planning a training on various things. That's one of them. All right. So here are our loan officers. You guys know who I am. Barnaby Robles is one of our branch managers. He's co-managing this relationship as your preferred lender here. We have Jose Casa. Everybody loves him here. We have Sandy Jimenez. He's working, I believe, the Doral branch. Ivan Severiche is working the Pembroke Pines branch. Damaris is also working the Pembroke Pines branch. We have Eduardo Correa, who is not here today. I'm sure he has a really good reason why he's not here today, but he's working the Bird Road branch. We have Martez, who works remotely, so he can work with anybody. And we have Brigida, who's working the Doral branch. And by the way, Brigida is an excellent resource for down payment assistance of all shapes and sizes. We have Kerry Romero, who is working the Aventura branch, also does a lot of down payment assistance. And she does a lot of loans in Chicago. So if you have buyers and you're referring out to Chicago, she could be a good resource for you. What was that? Buy downs, yeah, that's right. She does a lot of buy downs. And we have Ann DaCosta. She's as quiet as a mouse, but she knows what she's doing, and she also speaks a different language. What's that language you speak?
Hindi.
Hindi. So if by chance you have a buyer that's Hindi, she's a good resource for you. And then we have Patrick Flores. We won't hold it against him that he's Puerto Rican, but he speaks Spanish, and he knows this stuff. So, you know, that concludes our training. Do you guys have any questions? Happy to answer them. Thank you for attending, and I hope that you got some value out of this.